skyrocketing interest rates, GICs are getting supercharged. 1 year ago, GICs were at 1.4% and rent yields were at 4%. Nowadays, 1 year GICs are at 4.5% and rent yields are sitting at around 5.5% at best. The gap between the two are definitely compressing and GICs are looking pretty good these days. But is it a better choice than investing in real estate? Well, it does really come down to risk and reward, so let's break it down and take a deeper dive into this topic for this video. But before I continue, don't forget to give this video a thumbs up and subscribe to our channel so you don't miss other videos like this made specifically for real estate investors in Toronto. Just as a refresher, the way that most real estate investors compare rents is by looking at something called the cap rate, which takes your net rental income before mortgage payments and dividing that by your property price. So if you buy a rental property with just cash, the cap rate is essentially the yield you get from rental income. Right now, the best cap rates in Toronto are somewhere between 5 to 6%, and GICs are at around 4.5%. And so that difference is getting closer. The other thing to note is that the risk is also different. GICs are definitely lower risk since it's guaranteed by the government. You don't need nearly as much money to invest with, and it is a lot less work compared to managing a rental property. So from purely an income standpoint, GICs probably seem like a pretty good choice these days. Now, not everyone can buy real estate with just cash, so let's see how yields compare if we realistically take on a mortgage. If we use future peak interest rates at 5.5% and a 20% down payment plus closing costs, your net rental income as a percentage of your investment capital ends up being 4.7%. So when you compare this with GICs at 4.5%, that gap is even closer, and yet your risk goes up even more with a mortgage. And so GICs win again from purely an income standpoint. But with all these comparisons, we left out one big factor why we invest in real estate, which is the fact that real estate prices do go up in value over time. Ever since the late 70s, Toronto real estate has seen an average of 7% in appreciation, and once you add that to your return calculations, you'll find that real estate returns end up looking much better in the long term. Of course, past performance doesn't always predict the future, and if you believe that real estate price growth should be more in line with long-term inflation closer to 2 to 3% per year, then this would make a big difference to your returns, but it still looks much better than putting your money in GICs in the long run. Now, I know there is a real risk that real estate prices could still come down from here on. RBC recently said that they believe Canadian markets will bottom out in the spring of next year, 2023, falling 14% from the peak. Right now, it's down 7.4% so far across the country. And so if you are looking at Canada as a whole, I do agree that it is a real risk. And if you think so too, then you probably should wait until there are clearer signs of bottoming. Looking at Ontario, RBC expects bigger declines of 16% from the peak. But check this out, 416 detached homes have already fallen 21% from the peak. 416 semis have already fallen 27% from the peak, and it's only condos that haven't reached there yet, down 11%. And you've probably heard me say this before, investors tend to be more sophisticated, and so they usually price in future rate hikes ahead of time, which makes prices more responsive to interest rate movements. If you believe this too, then it's possible that we might be pretty close to the bottom in the Toronto investment property market. So let's walk through an example and say you end up buying a property at a 30% discount from the peak, and after that, prices would probably still fluctuate in the short term, but in the end, prices end up recovering in 3 years' time by the end of 2025. This means your property will appreciate 12.6% per year over the next 3 years. And once you crunch the numbers and add that to your rental income, this translates to a 58% return on your investment capital each year during the next 3 years. After that, things might stabilize at the long-term returns that we talked about before. Again, real estate is definitely higher risk than GICs, but if you are willing to take on that risk and work, then you'd get the potential for much better returns in the long run. With the end of rate hikes getting closer and closer, we're seeing a lot more investors come to us asking what Toronto real estate deals look like these days. Honestly, it's still very seller dependent, and the truth is you just have to keep trying. If you're looking to invest, first of all, get pre-qualified with a mortgage so that we can narrow down your sandbox, and then just connect with us. We're a real estate sales brokerage that focuses on investing in freeholds in core Toronto, and we can help you figure out what's best for you. We'll show you different opportunities from a numbers, time, and work commitment standpoint so that you truly know what you're in for, which helps you make better investing decisions. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.